Hey everyone. So, raise your hand if your investment portfolio currently feels less like a strategic asset allocation and more like a poorly executed Jenga tower in a mild earthquake. Yeah, me too. We've been living through this strange economic era where the stock market acts like gravity is purely optional, and everyone seems thrilled to buy an electric vehicle startup that has never actually, built a car. It's exhilarating, but lately there's a weird, persistent feeling, like the financial system is playing a really old jazz tune, and it sounds suspiciously familiar. And here's the absolute shocker. That familiar tune is the Roaring Twenties. We aren't just seeing harmless echoes of the past, we are witnessing an almost comedic, beat-for-beat remake of 1929. The main difference is, back then, people were just borrowing money to buy regular stocks. Today, we're borrowing money for companies that only exist because the interest rate is still convinced it's zero. We're living in a massive, interconnected, multi-bubble environment that makes the original Great Depression look like a simple practice round. Now, you might feel like that pessimistic friend at the party who keeps pointing out that the punch is spiked and the balcony railing is loose. Trust that feeling, because every historical marker, from the absurd, gaping wealth inequality to the sheer volume of speculative zombie firms floating around, is flashing a code red. This isn't just theory. This is recognizing that the economic foundation is cracking right beneath the floorboards, and most people are simply distracted by the flashing neon signs of the new paradigm, while the smart money rushes for the exits. Don't be the distracted one. But here is the good news and the key to surviving the coming system reset. While the crowd panics, we're going to dive deep into the specific structural time bombs, decode the Fed's fatal dilemma, and, in the final most important act, give you the exact, actionable strategy the world's most informed investors are using right now. From shifting to real assets to mastering the art of financial defense, stick around, because this is the history lesson you absolutely cannot afford to ignore. This is the Finance Podcast channel. I'm Dr. Arthur Sterling, and as a 20-year veteran economist, I provide the innovative takes you need on global economy and monetary policy. Click subscribe now to unlock a new level of financial understanding. So, let's step into Act 1 of our financial thriller. We call this the Delusion of Easy Money. When most people think about 1929, they picture those guys in fedoras standing in bread lines, right? But what was the engine that actually drove them there? Back in 1929, the bubble was inflated by individual madness. It was called margin trading. You only put down $10 and you borrowed $90 to buy $100 worth of stock. How easy is that money? It was basically individuals betting everything they had on a market they thought would never drop. It was a party. Until the margin call came, and everything vanished overnight. But here is the thing that is scarier about 2025. The bubble is no longer being blown by you. It's being blown by the government and the central banks for you. After the 2008 crisis, central banks implemented ZIRP, zero interest rate policy, for over a decade. The stated goal was to stimulate the economy, but what they really did was create a cash-filled swimming pool of free money. And the consequence? A phenomenon called zombie companies. A zombie company is a business whose profit doesn't cover its interest payments. They are only surviving because the cost of borrowing is virtually zero. We're not just talking about new startups. We're talking about thousands of large, publicly traded firms. We've put these companies on life support. And now, if you try to unplug that life support by raising rates, the entire economy gets into serious trouble. This is a structural bubble, created out of Washington, D.C., not Wall Street. In 1929, the leverage was concentrated in individuals. In 2025, the leverage has moved to the national level. Look at the debt data. First, corporate debt to GDP is at a record high, surpassing even the 2008 peak. Corporations are borrowing like crazy to fund stock buybacks, pumping up paper prices instead of investing in factories, equipment, or R&D. This is inflating paper value, not real value. Second, government debt to GDP. We have reached a point where servicing that national debt has become one of the government's single largest expenditures. Every dollar spent on interest is a dollar not spent on infrastructure, education, or healthcare. We are mortgaging the future just to maintain the present. And the most common mistake the media keeps repeating, they tell you, don't worry, these tech stocks are worth it because this time is different. They only look at PE, but how do you measure the earnings of a company that has never had any earnings? Instead, we need to look at P/S, price to sales. You'll see tech companies valued at hundreds of billions whose P/S ratios are sky high, based entirely on a promise. It's just like the Radio Corporation of America, RCA, in 1929. They believed technology would change everything, and all valuation rules were thrown out the window. This is the small lesson here. When money is easy, risk becomes invisible. The entire system right now is built on one simple delusion. Tomorrow will always be better. Debts are restructured. Bubbles are inflated, all in the hope that future growth will arrive and rescue us. But what happens when that tomorrow doesn't show up? That is when the wealth inequality, which we are going to explore next, starts turning an ordinary recession into a genuine economic collapse. Okay, now we move to part 2, the Great Divergence. This is where the historical comparison stops being merely concerning and starts becoming genuinely terrifying. If part 1 was about debt, this part is about division. Everyone romanticizes the Roaring Twenties, but it was a period of shocking inequality. In the late 1920s, the top 1% controlled about 23% of all wealth. That was seen as wildly unsustainable. The wealth was bubbling up to the very top, creating a weak consumption base. Fast forward to today, 2025. You ready for this number? The top 1% now controls over 32% of all wealth. Let that sink in. We are not just repeating 1929's inequality. We have surpassed the levels of the Gilded Age robber barons. We are living in a more financially stratified society than almost any point in modern American history. Now, why does this matter? Because the rich can only buy so much. They can buy 5 yachts, 10 mansions, and a private jet, but that's not what drives the economy. What drives the economy? The middle class buying necessities. Consumption is roughly 70% of the US GDP. When the top 1% hoards wealth, they inject it back into speculative assets, stocks, crypto, real estate, which inflates those bubbles. The middle class, meanwhile, is getting squeezed. They see asset prices soaring while their wages are stagnant relative to inflation. And here's the cruel irony of the post-2008 era. The rise in interest rates necessary to fight recent inflation has been a double whammy for the middle class. Think about it. In 2020, money was free. You could potentially afford a house. Now, with rates up, that same house payment is maybe 50% higher. This one policy decision, raising rates, has wiped out home ownership affordability for an entire generation. They are burdened by debt, student loans, credit cards, and they can't afford the basics because inflation hit them first, and then high rates hit them second. The middle class is the engine, but they're running on empty, weighed down by debt and watching their future evaporate as the asset owners at the top get richer from the very policies that are sinking them. This is the true great divergence. The small lesson here is that an economy cannot thrive when its foundation is starved. You can't build prosperity on speculation alone. Real growth requires broad consumer demand. And when that middle-class consumer finally cracks, they expose the fatal flaw of the system, the massive, fragile debt structure we discussed in Part 1. That system is now ready to crumble, and in our next segment, we're going to look at the structural time bombs, the multi-bubbles, that are guaranteed to fail simultaneously. Alright, if the first two parts felt like bad news, buckle up. We're now moving into the core reason why 2025 will be fundamentally worse than 1929. The structural time bomb. In 1929, the speculation was mostly concentrated in one place, the stock market. When the Dow Jones crashed, it was horrible, but the rest of the economy, real estate, corporate bonds, it didn't all catch fire at the exact same moment. Today, we have multi-bubbles. It's like holding 5 ticking clocks at once. You've got the stock bubble, sure, but look at the bond market. This is typically the boring part, right? But central banks, through quantitative easing, QE, were buying up bonds for years to keep rates low. They literally propped up the market. Now, through quantitative tightening, QT, they are slowly letting go. When money stops flowing freely into the bond market, prices fall and interest rates climb. This destroys the value of every old bond sitting on the balance sheets of banks and pension funds. It's a massive, silent devaluation. And the commercial real estate, CRE market, it's a disaster movie playing in slow motion. Thanks to remote work, office towers are emptying out. Malls? They're turning into ghost towns. The value of that CRE is collapsing. Who holds the debt for those towers and malls? Mostly regional banks. They're sitting on hundreds of billions in underwater assets, waiting for the loans to mature so they have to admit the loss. If one of these banks cracks, it's not an isolated failure. It's a domino effect, amplified by an already fragile financial community. And then we have the new kids on the block, crypto and private equity. Assets with valuations based entirely on hopium and venture capital funds trying to spend their cheap money. These are bubbles 1929 didn't even have the imagination to invent. Now, let's talk about the big philosophical shift. In 1929, the system was tied, however loosely, to the gold standard. There were some limits to money creation. Today, we live under a fiat system, money backed only by the government's word. This is why the bubbles are bigger. When you can print unlimited money, you can inflate a bubble far beyond what was possible a century ago. But this ability to print money also creates a hidden existential risk, a currency crisis. If people lose faith in the dollar, not just the stock market, the game is over. And finally, speed. In the 1920s, a crash took weeks. People had to physically call their brokers. Today, we have algorithmic trading. When the selling starts, it won't be a gradual decline. It will be a near instantaneous collapse, amplified by machines trading at the speed of light. This crash won't just be fast, it will be brutal and instantaneous. The small lesson here? Interconnectedness kills. When multiple systems, bonds, real estate, tech stocks, are all dependent on the same supply of cheap money, they all fail together when that supply is cut. Which brings us to the moment of truth, the fatal dilemma facing the world's central bankers. In the next part, we'll reveal the trigger that will set off these time bombs and why the Fed's only solution will be the final, catastrophic mistake. This is it. We've established the enormous amount of debt, the crippling inequality, and the multiple ticking structural time bombs. Now we ask, what is the trigger? And what is the fatal mistake the people in charge are guaranteed to make? In 1929, the crisis was fundamentally one of liquidity and deflation. The problem was not too much money. It was that the money froze up and prices collapsed. The solution, eventually, was printing money. Today, the crisis is one of sticky inflation combined with massive debt. The Federal Reserve and other central banks face a dilemma they have not seen since the 1970s, but this time the debt levels are astronomical. They have two levers. Lever A, fight inflation. They must keep rates high or raise them until inflation is truly dead. But this kills the zombie companies. It implodes the commercial real estate market, and it crashes the bond market. It guarantees a depression. Lever B, save the markets. They must cut rates and start printing money, QE, again, to save the banks, stop the market crash, and bail out the government debt. But this guarantees that the inflation we just experienced becomes permanent and potentially turns into hyperinflation. They cannot do both. It's a game of chicken where one choice causes financial collapse and the other causes monetary collapse. They are trapped. History teaches us what they will choose. They will choose to save the system, which means they will choose lever B. They will print money. They will initiate QE Part 4, 5, or 6. They will do this because the alternative, allowing a true debt liquidation, is politically and institutionally unacceptable. And this is where the legitimacy crisis comes in. In the 1920s, despite the hardship, people generally believed in the system. Today, trust in government, media, and financial institutions is at historic lows. When the Fed implements QE again to bail out banks and billionaires, knowing it will destroy the purchasing power of the middle class through inflation, the social contract will break. This collapse won't just be economic, it will be a breakdown of social order. The fatal mistake is choosing to solve a debt problem, too much easy money, by creating even more easy money. Example, they will talk about controlled inflation or temporary measures. But this is the lie. Every time they print, they are transferring wealth from savers and wage earners to the debt holders, the government and the rich. The small lesson here? The government always chooses its survival over your savings. Your government will always default on its promises through inflation rather than defaulting on its debt. So, if we know they are trapped and we know their only way out is to inflate the currency, to choose the monetary collapse path, how do we, the rational few, protect ourselves? That brings us to our final and most crucial segment, positioning and preparation. We've arrived at the final and most critical part. If all the analysis up to this point has left you feeling a little shaky, that's good, because fear isn't the goal, preparedness is. This segment is not about panic, it's about positioning and preparation. First lesson, you must choose to analyze risk over reward. When everyone is talking about the next 10x stock, you should be asking, what is the worst case scenario if this entire system implodes? Let's look at the smart money, the billionaires buying up farmland and building bunkers. They aren't preparing for a correction, they are preparing for a system reset. They understand the Fed's fatal mistake means protecting their wealth from two things, market crash and currency devaluation. Example, why farmland? Because even if the dollar becomes worthless, land produces food. It's a productive asset. It's the ultimate hedge against civilizational collapse. So, what do? We, the rational few, must adopt a financial defense strategy. Priority 1. Liquidity and debt. Cut the debt. Stop paying interest to keep your zombie life going. Get rid of the high-interest debt, credit cards, consumer loans. Build an emergency fund of 6 to 12 months of expenses, not 3 months, 12. Cash is king when confidence collapses, and opportunities are bought with liquid assets, not with margin debt. Priority 2. The currency hedge. We know the government will print money to survive. Therefore, your savings are under attack. The best defense against monetary devaluation is an asset outside the fiat system. I'm talking about physical gold and silver, not for speculative gains, but as insurance. Think of them as stored human labor that cannot be debased by a politician's printing press. When confidence collapses, people rush to what is historically sound. Priority 3. Reevaluate your stock holdings. Shift away from those high P/S, high-growth, no-profit stocks. You want value stocks, companies with strong balance sheets, low debt, and crucially, positive free cash flow. These are companies that can weather the storm, continue paying dividends, and even buy back their own stock with real money when the market crashes. The echoes of 1929 are loud. The delusion that this time is different is strong. But you, the viewer, are now armed with the history and the blueprint for what is coming. This is not just a crash, it is the global financial system reset that has been postponed since 2008. You have the choice. You can let history repeat, watch the curtain fall, and be crushed by the consequences. Or you can prepare now, position yourself defensively, and be one of the few who is ready to buy the assets of the unprepared when the dust finally settles. The smart money is already done buying land. Are you listening? Thank you for watching.